The bond market, often known as the debt market, encompasses all debt securities sales and issues. Bonds are frequently issued by governments to obtain funds, pay off debt, or support infrastructure upgrades. Bonds are also issued by publicly traded corporations to fund expansion initiatives or to keep operations running. Many investors look to bonds as an alternative to stocks in unpredictable markets. Even while bonds are considered safe investments, investors should be aware that bonds, like all investments, entail some risk, which will be carefully assessed. Welcome to Gray Skies Media, and we're here to help you invest in your future. Please, do us a favor and hit that like and subscribe buttons for more content like this. In today's video, we're going to review exactly what the bond market is. The bond market is divided into two sections: primary market and secondary market. The primary market is often known as the new issues market since transactions take place directly between bond issuers and bond buyers. In essence, the primary market creates new debt instruments that have never been sold to the public before. Securities that have already been issued in the primary market are bought and sold in the secondary market. These bonds can be purchased from a broker in the form of pension funds, mutual funds, and life insurance plans. If you're thinking about buying bonds, you should know that not all bonds are created equal. Bonds are issued by corporations and governments to fund their day-to-day operations, or to fund special initiatives. When an investor purchases a bond, he or she is effectively lending money to the bond issuer for a set period of time. When the bond matures, investors receive the principal amount plus interest in exchange for lending funds. The issue price of a bond is referred to as its par value, and the interest payment is referred to as its coupon. Bond prices will change during the trading day, just like stock prices. The coupon payment on most bonds, however, will remain constant, though some floating rate instruments do exist. If an investor buys a bond in the secondary market for face value, the bond is said to be sold at par. A bond is sold at a premium if its price exceeds its face value. A bond is offered at a discount if its price is less than its face value. There are three main categories of bonds: government, corporate, and municipal. Government bonds, known as treasuries in the United States, are by far the most active and liquid bond market today. A treasury bill is a 1 year or less maturing U.S. government debt obligation backed by the Treasury Department. A treasury note is a U.S. government debt product with a fixed interest rate and maturities ranging from 1 to 10 years. Treasury bonds are federal debt instruments issued by the United States federal government with maturities of more than 20 years. Bond investors seeking low-risk investments might consider U.S. treasuries, which are backed by the U.S. government. Corporate bonds. Companies issue corporate bonds to raise funds for a variety of purposes, including financing existing operations, expanding product lines, and establishing new industrial facilities. Corporate bonds are typically longer-term financial securities with a maturity of at least 1 year. Corporate bonds are normally divided into two categories: investment grade and junk bonds. This classification is based on the bonds and issuer's credit rating. An investment grade rating denotes a high-quality bond with a low chance of default. Bond rating agencies, such as Standard & Poor's and Moody's, employ various designations consisting of upper and lowercase letters A and B to indicate the credit quality rating of a bond. Junk bonds have a higher chance of default than most corporate and government bonds since they're issued by companies that are financially distressed and have a high probability of defaulting. Junk bonds are sometimes known as high-yield bonds, since a larger yield is required to help balance the risk of default. These bonds have credit ratings that are lower than BBBs. Municipal bonds. Municipal bonds are often known as muni bonds and are issued locally by states, cities, special purpose districts, public utility districts, school districts, and other agencies to fund projects. Municipal bonds are frequently tax-free at the federal level and can also be tax-exempt at the state or local level, making them appealing to eligible tax-conscious investors. Munis are classified into two categories. A general obligation bond, or GO, is a bond issued by a government that is not guaranteed by revenue from a specific project, such as a toll road. Some GO bonds are supported by specific property taxes, while others are supported by general funds. A revenue bond, on the other hand, is secured by the issuer or by sales, gasoline, hotel occupancy, or other taxes. When a municipality issues bonds as a conduit, a third entity pays the interest and principal. Mortgage-backed bonds. Mortgage-backed bond offerings, which are made up of pooled mortgages on real estate, are secured by the promise of specific collateralized assets. When an investor purchases a mortgage-backed asset, he or she is effectively lending money to home buyers through their lenders. These often pay interest on a monthly, quarterly, or semi-annual basis. The mortgage-backed security is an asset-backed security. As the subprime mortgage debacle of 2008 demonstrated, a mortgage-backed asset is only as good as the mortgages that back it up. Emerging market bonds. These are bonds issued by government and corporations in developing nations that provide significantly bigger growth prospects, but also significantly more risk than domestic or developed bond markets. The risks of investing in these bonds include the normal risks associated with all debt issuance, such as the issuer's economic or financial performance and the issuer's ability to meet payment obligations. However, these risks are heightened by emerging countries' potential political and economic volatility, as well as the exchange rate swings and currency devaluations. The Bloomberg Aggregate Bond Index, the Merrill Lynch Domestic Master, and the Citigroup U.S. Board Investment Grade Bond Index track and assess corporate bond portfolio performance in the same way that the S&P 500 and the Russell indexes track equities. Many bond indexes are constituents of larger indices that track the performance of global bond portfolios. The Bloomberg Government Corporate Bond Index, or AG, is a significant market-weighted benchmark index. It, like other benchmark indexes, gives investors a standard against which to compare the performance of a fund or investment. Bonds are distinct from stocks in a number of ways. Bonds are used to finance debt, whereas stocks are used to fund equity. Bonds are a type of credit in which the borrower is responsible for repaying the bond's owner's principal as well as additional interest. Stocks don't entitle the owner to a return of capital or obligate the company to pay dividends. Bonds are often less risky than stocks and give lower yields due to the legal safeguards and assurances they provide. Most financial experts agree that a well-diversified portfolio should have some exposure to the bond market. Bonds can be an important component of an asset allocation strategy and can help diversify your portfolio. Diversification, however, does not guarantee a profit or safeguard against loss in deteriorating markets. Your long-term financial goals and objectives, risk tolerance, investing time horizon, and ability to invest will all influence how much your portfolio should be dedicated to bond investments. What do you think about the video? Please, let us know in the comments, and don't forget to like and subscribe. Click on that bell icon so you never miss an upload. See you in the next one.